I'm joined by Daniel Hui. He is Senior Forex Strategist at HSBC, joins me here in Hong Kong. Good to see you. So the sterling, I mean, this depreciation that we've seen of late, is that more down to concerns about growth in the UK being hit by these austerity measures, or perhaps this prospect that the Bank of England could print yet more money?
Well, I mean, I think that's two sides of the same coin. I think, you know, weakness that the Bank of England is going to have to expect because of such harsh austerity measures will have them looking at how to support growth and, importantly, how to prevent deflation. So I think the U.S. dollar in recent months have been hit by, you know, the market getting quite excited about when and how the Fed might institute quantitative easing. I think they've kind of left the sterling out of the limelight. But I think the market will start talking about, you know, again, when, how, and when, in what manner the BOE might extend its quantitative easing program. So I think we are looking for sterling weakness going forward. But
for now and in recent months, the focus is firmly on the dollar, as
yes.
you say, and this expected QE that we are looking for from the Fed
yes.
November 2nd and 3rd. Now, in terms of the amount, what are you looking for? Are you looking for a gradual introduction of more QE, or do you think we might get a surprise shock and awe approach?
Well, I mean, I think calling something gradual or calling something shock and awe is a bit interesting when we're talking about quantitative easing, because it is so unusual. I mean, what we're expecting is something around 500 billion. I think that's quite close to a market average. But we do think that looking at where interest rates could be if they could go negative, essentially using a Taylor rule type of measurement tool, we think that the eventual expansion of QE could be as large as 2 trillion. If the Fed is, serious
right.
about preventing deflation. So, this explains why the market has been so focused on selling the dollar.
We're running out of time, believe it or not, but I was speaking to an investment strategist this morning, and he was saying this is an incredibly difficult market to trade. You've got the Japanese central bank doing one thing, the Europeans doing another, the U.S. doing another. How do you do it? How do you trade it?
Well, I think currency war, this focus on dollar weakness and how other countries respond to it will continue to drive markets, not just G10 FX markets, but emerging currencies as well. In particular in Asia, the way we like to trade it is to really look at which policy authorities are most comfortable with currency strength and look at what policy authorities are most resistant against capital controls, and we like to invest there.
Okay.
So that means Singapore dollar, Malaysia ringgit, Philippine peso, and in a short-term sense, Indian rupee as well. So that's where our favorite longs would be in the Asian currency world.
Daniel Hui from HSBC, we thank you very much for joining us.